Hello everybody, the topic of this section is why yields for the same maturity may differ. Often we observe that two U.S. Treasury bonds with the same maturity have different yields to maturity. Is this a violation of the law of one price? The answer is no. In fact, for bonds with different coupon rates, the law of one price implies that unless the yield curve is flat, bonds of the same maturity will have different yields to maturity. There are many effects on the yield to maturity. First, let's see the effect of the coupon rate by an example. Consider two different 2-year coupon bonds, one with the coupon rate of 5% and the other with the coupon rate of 10%. Suppose the current market prices and yields of 1- and 2-year pure discount bonds are as follows in the table. For the 5% coupon bond, the market price is equal to the coupon, 1,000 multiply 5% multiply the per dollar price of the first year cash flow, plus the face value 1,000 plus coupon multiply the per dollar price of the second year cash flow. The market price is found as $982.57. For the yield to maturity, apply the formula of the market price expressed by the present values of the annual coupons and the face value. Solving the following equation, the yield to maturity is 5.95%. By the similar arguments, we can find the market price and the yield to maturity for the 10% coupon bond. Its market price is $1,075.15, and the corresponding yield to maturity is 5.91%. In this example, the maturity of these two coupon bonds are the same 2 years, but their coupon rates are different, and we found that the corresponding yields to maturity are also different. Thus, we see that in order to obey the law of one price, the two bonds must have different yields to maturity. As a general principle, when the yield curve is not flat, bonds of the same maturity with different coupon rates have different yields to maturity. Here is a quiz. Suppose the current market prices and yields of 1- and 2-year pure discount bonds are as in the following table. What would be the market price and yield to maturity on a 2-year coupon bond with a coupon rate of 4% per year? The market price is equal to the coupon 1,000 multiply 5% multiply the per dollar price of the first year cash flow plus the face value 1,000 plus coupon multiply the per year dollar price of the second year cash flow. The market price is found as $964.06. For the yield to maturity, apply the formula of the market price expressed by the present values of the annual coupons and the face value, and then solve the following equation. Finally, the yield to maturity is obtained as 5.96%. That's all about the effect of the coupon rate. Bonds offering the same future stream of promised payments can differ in a number of ways, but the two most important are default risk and taxability. Default risk refers to the possibility that the issuer of bonds may not be able to repay the principal and interest on schedule, and the higher the default risk, the higher yield of the bond. The taxability of bonds can vary according to the issuer or type of bonds, and this fact will certainly influence their price. What investors really care about is the real income after tax. Other things equal, the exemption of income taxes makes a bond more attractive to tax-paying investors and will cause their prices to be higher and their yields lower than otherwise comparable bonds. There are many other features that may differentiate seemingly identical fixed income securities and therefore cause their prices to differ. The following two bond features should also be considered. One is callability. Callability gives the issuer of the bond the right to redeem it before the final maturity date. A bond that has this feature is a callable bond. Another one is convertibility. It gives the holder of a bond issued by a corporation the right to convert the bond into a pre-specified number of shares of common stock. A bond that has this feature is a convertible bond. Callability will cause a bond to have a lower price and a higher yield to maturity. Convertibility will cause a bond to have a higher price and a lower yield to maturity. In summary, in this section, we have discussed the reasons why yields for the same maturity may differ. The effect of the coupon rate was discussed by some example. The default risk, taxes, callability, and convertibility were also introduced. That's all about this section. Bye.